Good afternoon, everybody. I'm Stephen Woodhouse, and I'm with a colleague, Tom Williams, here to talk about REMA, and in particular, the study that we've been doing looking at what we're calling enhanced national market designs for the GB power market. So I think the session will be recorded. You'll be able to listen to the recording later. We'll send around the details. There are questions and answers being put in the discussion as we speak, so please use the Q&A rather than the chat function. We'll answer as many questions as we can during the course of the discussion. We may follow up to the attendees later on if there are ones that we don't get time for, or if they're difficult questions. We've had half a dozen questions in advance, which we'll endeavour to answer during this 1 hour session. So thank you all for taking the time to join. REMA has been rumbling for some time. So I'm Stephen Woodhouse. I'm a director with AFRY, been with the company 25 years or so. I've been working on market design, including even before that time when I was working with Ofgem on what we now call NETA. And Tom has been working with me for quite a few of those years on market design and related offences. So the REMA process, I'm sure you're all familiar with, it came out in about 2022. And even before that, NESO were making the case for a nodal market with central dispatch. And actually, in the markets day in 2022, I was down in the basement in Geek Corner presenting on some work we'd done on stability and reactive power market designs. But when I came upstairs, there was a discussion of these very fundamental transformations. And when 25 years ago I first heard about nodal pricing and central dispatch, I thought, what a lovely idea. And I've spent the last 25 years realizing some of the downsides. So we created this project by talking to a bunch of industry people, trying to get an open evaluation of the various ideas that were on the table. And I think it's fair to say quite a few of the clients were opposing change. But we at AFRY never were and still are not. What we're saying is if we make changes, we have to make the right changes and in the right way. And we were kind of on the fence between zonal and national pricing. And there were certainly pros and cons of both that we acknowledged. We were not part of the polarization of the debate. And we've had observers throughout the process from DESNZ, from Ofgem, from NESO, and in parts from NGET. And it's been a very transparent process, and anything at with the document saying AFRY at the bottom is our opinion, and you can be sure that the paying clients have had some input to those decisions and those viewpoints, but they remain our viewpoints. This is not an industry lobby group paper, and it's certainly not the anti-brigade putting their best arguments forward. So it's meant to be a neutral evaluation of the issues. And 6 months ago, we tried to get going 2 parallel studies, one to look at an enhanced national market and one to look at the preconditions for making a zonal market effective. And it happened at the time that this was the study that went ahead. So we've seen on the left, if you look at the chart, the whole wide range of issues that were initially put on the table by DESNZ in 2022. And it's been whittled down over time, including most recently minded not to include central dispatch as part of the thinking, but zonal pricing is very firmly still on the table, and there are lots of variants of that, and separately some issues around shortening the settlement period from the present 30 minutes, and a number of other points which we will pick up as well. So, for example, within the REMA process, not particularly minded to take forward changes on the interconnector operation, but we have taken that forward, and it can be taken forward in another forum, not purely within REMA. There were some other ideas floated as well, which relate to how smaller scale assets could be incorporated better into the trading arrangements, and also over perhaps the access regime, not for generation in the main, but perhaps for storage assets. So those are the things that the DESNZ is currently leaving open. But this study was very much focused on an enhanced national market design. So what we've done is try to identify some market design features that could improve the operation of the existing national market, which is then characterized by redispatch to deal with transmission congestion. But we felt it was important to quantify this. So although it's a market design study, a substantial share of the effort has been in the modeling and the quantification of the cases that we've been looking at. So we were looking at operational efficiency. The work we've done previously looked at both operational and investment efficiency, but it has been our conclusion that Britain already has locational incentives on all classes of generator and consumer. You can debate their effectiveness, but through both the tenuous charging and the transmission loss regime, which mustn't be underestimated, we've got incentives which could drive investment. Now, whether they could be sharpened or tweaked or changed is a moot point, but we considered that you might be able to get the appropriate locational incentives without moving to locational energy spot prices. So we have excluded the investment efficiency from the operational efficiency changes that would manifest from zonal pricing. So we have looked at issues that would have an impact on operational efficiency, and Tom will talk through that in a bit more detail. So as I said, we're very grateful to the 7 industry members who are the funding sponsors for this project, and I hope they would agree that we have at least listened to them. But we always say in these things that, you know, we are the ones that hold the pen. So this is, as I say, our very best attempt to strike a balance between the competing views and to make recommendations that we think are in the economic interest of Britain as a whole. So over to you, I think, Tom.
Okay, thank you, Stephen. So yeah, go on to the next slide, please. So as Stephen has mentioned, we've attempted to develop enhanced national market designs as part of this project that deliver improved operational efficiency. And in order to do that, it's useful first to consider what the current sources of operational inefficiency within the current arrangements are. And AFRY has previously examined this as part of the case for change for the current scheduling and dispatch arrangements on behalf of the National Energy System Operator, or NESO. And what that found was that there's potential for operational efficiency in 3 main areas. So firstly, energy markets do not provide scheduling incentives in line with system needs and operational requirements. So this reflects the fact that at the day-ahead stage, generators in a national market schedule themselves with no visibility of transmission and other system constraints, which are then managed by the system operator through a process of redispatch close to real time. And interconnectors are quite a prominent example of this, being both large assets and also harder than other assets for NESO to redispatch, given that interconnected system operators often don't want to see large changes in their own schedules close to real time. The second area is incomplete NESO visibility of market outcomes and limited access to some resources, impacting the coherence between wholesale markets and balancing. So this includes the effects of, for example, NESO not having visibility of the actual schedule of assets outside the balancing mechanism, when a lot of those are small-scale assets, and also limited processes and tools for optimizing large numbers of small-scale assets that actually are in the balancing mechanism at the moment. And then thirdly, the current dispatch mechanism does not facilitate effective optimization of costs and unit constraints over time. So as NESO redispatch, as it's currently designed, is intended to be a residual balancing role, it is less effective at considering optimal redispatch over multiple periods, which is the thing really that you need to make the best use of storage assets. And another difficulty is related to NESO not having visibility of the actual state of charge of storage assets, which has meant that they've tended to be underutilized compared to sometimes more expensive assets, which have a more visible delivery capability, which is the problem known as skipping. So these are potential areas of inefficiency have informed our choice of market design building blocks for the enhanced national cases, and these are management of interconnectors, management of small-scale assets, and management of storage assets. So if we move on to the next slide, please, Edwin. So our first market design building block is management of interconnectors, and we consider both pre-gate closure and post-gate closure arrangements. So taking pre-gate closure arrangements first, and the current arrangements that exist. So NISO at the moment can adjust interconnector flows pre-gate closure by entering into contracts with domestic generators to flow in the reverse market direction on the interconnector, which is known as counter trading. And shown on the chart are historical interconnector counter trade buy volumes by NISO on the southern interconnectors. And the black shaded area represents the volume of buy counter trades that NISO actually carried out, which reached 3.2 terawatt hours in 2022. And in particular months, interconnector counter trades have been utilized particularly heavily by NISO to manage the system. So in July 2022, for example, NISO interconnector buy counter trades actually represented 60% of overall positive balancing volumes. So quite a significant share of redispatch, and actually, perhaps more than people might expect when they consider redispatch of interconnectors being quite inflexible. But we've done some analysis of historical BSAD data, so the balancing service adjustment data, and that suggests that there was greater potential for cost-effective counter trading of interconnection, which is the additional volume of green that you can see on the chart. And we've identified that volume effectively by comparing the cost of a counter trade with the cost of the cheapest alternative action that was available in the balancing mechanism. And there were several other things that you have to consider too in terms of the state of the system and whether a counter trade would have helped, which we've also factored in. But we can see that there is a significant additional potential volume there in the green, and obviously unrealized potential for cost-effective counter trading would obviously be a source of operational inefficiency in the current arrangements if that's the case. Okay, next slide, please. So that brings us on to the reasons why interconnectors might not be being counter traded at their full economic potential at the moment. So what the graphic shows is the gate closure times for intraday capacity auctions on GB interconnectors. And the reason I'm showing that is that there's a few points. So the first thing to note is that on some interconnectors, there are currently no capacity auctions intraday. And that means at the moment there are no arrangements for counter trading. So for example, if you look at NSL to Norway, for example, those are set via a market coupling algorithm day ahead, and they can't currently be altered after that point. So no scope for NISO to do anything there. But for those interconnectors that do have counter trading based on explicit capacity auctions, so that's all GB interconnectors at the moment, other than those to Ireland and Norway, there are also limitations there, because NISO is currently limited in having to ensure that its counter trades get executed in the last available interconnector capacity auction. And the reason for that is that because the counter trade is a flow in the reverse market direction, it actually creates a net flow capacity back in the market flow direction, which, if there was a subsequent opportunity to trade in, other market participants would make use of that. So they have to therefore do it in the last closing auction to ensure that counter trade doesn't get unwound. So that in turn imposes some timing constraints on NISO procurements of the counter trade volumes required, because that obviously has to happen before the intraday capacity auctions on the interconnectors. So if we look at the graphic, it typically shows that on most of them there are 3 or 4 intraday capacity auctions on each interconnector. Generally, those are covering delivery blocks 4 to 8 hours long. IFA2 actually has a 12-hour block, and ElecLink only has 2, and they're 10 and 14 hours. And those auctions close 2 to 6 hours ahead of the first delivery period within the block. So the upshot of all of that is that depending on the interconnector and the time of day, at best NISO can influence flows around 3 hours ahead of real time, and at worst it's 16 hours ahead. and those lead times limit the quality of information that NISO has available to it when decisions about counter trading need to be taken, and increase the system management risk for NISO of counter trading. And then I guess, the final source of potential inefficiency is the lack of a 24/7 trading desk for counter trading purposes at NISO. And that, is a limitation on their ability to trade overnight. So, effectively missing out on the auctions in the black hatched box on the chart. Next slide, please. So moving on to improve market design for interconnectors pre-gate closure, we have an enhanced national case and also a more stretching enhanced national stretch case, which reflects greater ambition. So in the enhanced national case, which is on the left of the two, we propose firstly more frequent intraday capacity auctions, and each of those covering a smaller number of delivery periods and closing as close as possible to real time. We think on interconnectors that already have explicit capacity auctions, adding additional ones, should be relatively easy to implement. We also propose the introduction of intraday explicit capacity auctions for counter trading on the Irish and Norwegian interconnectors. And it is possible in principle to have both explicit and implicit capacity auctions on interconnectors. And finally, the introduction of a 24-hour a day trading capability at NISO to get those overnight trades in as well. Collectively, these enhancements should maximize NISO's potential to realize cost-effective counter trading based on the current approach of using a final explicit capacity auction to lock them in. And should be mostly achievable based on bilateral negotiations with interconnected markets. Moving over to the right and looking at the enhanced national stretch. In that case, we are further proposing that NISO would have the ability to lock in counter trades at an earlier stage, both for those interconnectors which currently have explicit auctions and for those with implicit auctions. And there are two possible ways that could be implemented. So the first one is novel use of net transfer capacity or NTC restrictions. So currently NTC restrictions may be applied by SOs intraday to limit the available capacity on an interconnector in a particular direction for a particular period, and that limits the market-based flows that would otherwise occur. One possible approach for locking in earlier counter trades would be for any counter trade by NISO to be accompanied by a simultaneous reduction in the NTC available to the market. However, there is a potential interaction with the use of NTCs in this way in the Trade and Cooperation Agreement that the UK has agreed with the EU. So Article 311 of the TCA requires that the maximum level of capacity of electricity interconnectors is made available, respecting the need to ensure secure system operation and the most efficient use of systems, and that electricity interconnect capacity can only be curtailed in emergency situations, and any such curtailment must take place in a non-discriminatory manner. So the use of NTC restrictions in conjunction with counter trading is potentially a topic that falls within or under the Trade and Cooperation Agreement. But we consider that it's at least arguable that the use of an NTC restriction to lock in a counter trade is not actually a curtailment of the interconnect capacity available to the market, given that the counter trade, which is permitted under the TCA in and of itself, is the sole reason that the potential market opportunity to do another trade in the market direction arises. So it would potentially be allowed through that sort of loophole, if we can call it that. And in addition, an NTC restriction implemented simultaneously with a counter trade could be seen as a form of market-based reserve procurement by NISO as well. However, it's because of this extra complexity with potential EU level discussion that we've distinguished this measure into an enhanced national stretch design. And then Secondly, then, in terms of the other technique, so for interconnectors with implicit coupling, there is an alternative approach for locking in counter trades earlier, and that would be for the market operator for the implicit coupling to offer a new product, setting a specific price for an actual capacity product. And that can be actually used within the algorithm to determine prices and flows. And the other thing, of course, is that as well as enabling the locking of counter trades in earlier timeframes, the potential for that type of solution means that counter trading could actually remain an enduring solution, even if all the interconnectors with GB all move back to full implicit market coupling. So yeah, you can think of it's not necessarily dependent that yeah, counter trading has to have interconnectors with explicit capacity auctions as we do now. There is a route and a possibility to also do this with full implicit coupling. So overall then, earlier counter trades would potentially enable the majority of NISA actions to be visible to interconnected SOs at an earlier stage than the last intraday auction. And yeah, make changes in flows easier to manage. And because they're in earlier timeframes, they've also got the potential to be obtained at lower cost as well. Yeah, it is a reality that any proposed extensions to the current ability of NISO to do counter trades, would potentially, yeah, cause concern, and perhaps particularly with the Norwegian and the Irish SOs who also face transmission congestion networks. So yeah, key to all of these interconnector arrangements is ensuring that they're mutually beneficial reciprocal arrangements. Otherwise, it's unlikely that you'll be able to get the agreement required. Okay, so moving on then to interconnectors post-gate closure. And yeah, if we just, in terms of current arrangements, there are some interconnector actions that take place post-gate closure. So there's a small amount of SO to SO trades that are done mostly for balancing energy. There are exceptions to whether there are any arrangements. So there aren't any on NEMO or to NSL to Norway at the moment. And generally speaking, yeah, the pricing isn't terribly attractive to NISO. It's rather undynamic, and there's also a lack of firmness in terms of whether the volume will actually be there when it's needed. So they tend to get used as a last resort, yeah, in emergency situations for system security issues. Although on the Irish interconnectors, there is actually a bit more use. So there's a 25 megawatt tranche of capacity that appears to be used more regularly for SO to SO trades. So again, for post-gate closure arrangements, we have two levels of ambition. So in the enhanced national, we think that incremental gains should be achievable. And realistically, only a limited volume of interconnector redispatch is likely to be available in balancing timeframes, yeah, due to the low availability and yeah, technical constraints that sometimes arise in interconnected markets. But expanding SO to SO trading to a level similar to that currently achieved with the Irish market should be achievable, given the small size of Ireland relative to Britain, and the fact that that's managed with Ireland today. In the enhanced national stretch, we've proposed improved access post-gate closure through improved cross-border balancing via a bilateral cross-border balancing platform, or potentially via direct nomination between SOs. And that would yeah, improve their NISO's ability to yeah, manage flows post-gate closure. As with the other measures, pre-gate closure implementation would be dependent on achieving cooperation between SOs on a basis of mutual benefit. And it's fair to say that on this one, implementation would be quite complex due to the need to coordinate competition between the different balancing markets and the lack of harmonized balancing products between GB and EU. And a loosely volume coupled cross-border balancing platform would actually be more complex to implement than the equivalent day-ahead loose volume coupling, which has itself been very much delayed and proved quite difficult to do. However, there is provision within the TCA to develop a bespoke GB EU balancing platform in place of TER or MARI, which we're excluded from at the moment. And potential appetite from interconnected SOs to put arrangements in place, might well be there because prior to Brexit, GB was part of the cross-border balancing initiative with continental SOs. Next slide, please. So moving on to our second market design block, management of small-scale assets. So these improvements are common actually to the enhanced national and the enhanced national stretch. The first item is improved quality of final physical notifications, which is actually broader than small-scale assets in the BM, but does include them as well. Improved accuracy of final physical notifications from all BMUs would enable NESO to take more efficient balancing decisions and reduce the occasions when there's unnecessary additional balancing actions occur. And that's particularly an issue for wind FPNs, which have tended to be relatively inaccurate. The next item is improved NESO forecasting tools and optimization processes for small-scale assets. So small-scale participation in the balancing mechanism has been limited by the difficulty to NESO of instructing a large number of small assets in real time, and that sometimes resulted in more expensive larger units being instructed instead. NESO has recently introduced new algorithm-based dispatch tools through the opening balancing platform, which enables dispatch instructions to be issued to multiple small units simultaneously. And longer term, NESO is examining ways to further improve forecasting of supply and demand to enable more informed decision making and ways to make dispatch instructions more efficient and faster. And NESO is looking also at building experience of dispatching aggregated units, which is including a BMU entirely composed of EV chargers, and also from the use of the demand flexibility service. So there's work underway in this area. If we move to the third element, which is the lowering of the capacity threshold for mandatory participation in the balancing mechanism to 10 megawatts for new assets, but not retrospectively. So the idea behind this is that if NESO gains access to a larger set of resources in the balancing mechanism, it would enable potentially lower cost balancing actions to be taken. And obviously wider participation in the balancing mechanism would also give NESO more direct visibility of the state of the system at each location, because there'd be more capacity submitting physical notifications. So it'd be better forecasting and improved ability to make redispatch decisions from that. And there is a grid modification proposal, GC0117, I think it is, which is coming in hopefully from 2027, that would reflect this. And then finally, we address the small scale assets that would remain outside the balancing mechanism. So below the mandatory threshold of 10, even in our design. So improved visibility and access to these assets could be achieved through improved information provision to the NESO in short-term planning and operational timeframes, extension of arrangements for NESO access to non-BMU resources through things like constraint management markets, and reduce barriers to voluntary participation in the BM and other balancing services. So again, improved visibility and ability to access those resources would enable better balancing decisions and hopefully more cost-effective ones. There are various initiatives underway to develop tools that enable greater NESO visibility to non-BMU resources. Local constraint management trial on the B6 boundary was one example, and there are long-term constraint management markets being developed via the Constraints Collaboration Project. One major barrier to voluntary participation in the balancing mechanism is the metering regime that would be required, which is proportionally more expensive for small units. So relaxation of those to be less onerous and expensive would probably increase participation. And I think, NESO is looking at that trade-off currently. Yeah, and the voluntary participation in other balancing services by non-BMUs can also be facilitated. Lowering barriers to entry. And sharing by NESO of information on potential opportunities. And the Power Responsive program being run by NESO is an example of that sort of thing. So there's work going on in that area too. Okay, so on the third aspect of the market design, the management of storage assets. So again, we've got arrangements common to both the enhanced national and enhanced national stretch designs. And the first proposal is to improve information sharing between NESO and storage assets. Improving visibility to NESO of the current state of charge would improve their confidence in their ability to deliver on the instruction, and perhaps increase their utilization when they're the lowest cost option. And improved information provision the other way on forecast constraints could also enable storage assets to be in a more optimal position to resolve them. There is a potential risk with that the risk of gaming might increase. So that would have to be coupled with a suitable market power mitigations. And we think credible enforcement of the transmission constraint license condition, which prevents excessive gains from exploitation of transmission constraints, should be a significant safeguard against that. The second feature under the market design element for storage assets is the improved management of intertemporal issues through the capability of NESO to commit usable energy from storage assets ahead of gate closure. And essentially, this centers on the idea of developing new multi-period products for storage assets that would enable NESO to commit usable energy ahead of time. And multiple period product design could be analogous to the balancing reserve product, but with some additional features. So including locational constraints in order that NESO could select storage bids and offers to help manage constraints. Products defined intraday rather than day ahead, or perhaps in addition to day ahead, and also have a duration constraint. So a plant that's accepted would need to be able to maintain output for say 4 hours or so. Next slide, please. So just to mention briefly, there are other areas of reform that could provide further operational efficiency gains as part of an enhanced national market design that we've not examined or quantified as part of this project. So those include things like reformed access rights for storage assets and reform of bidding behaviour by subsidised plants in the balancing mechanism. And some of these ideas are being progressed by NESO and others. Next slide, please. Okay, so in addition to carrying out a market design exercise, we did actually go to the trouble of quantifying the benefits using a fundamentals approach of our enhanced national designs, and also comparing that with a zonal alternative. Primarily it was the total social economic welfare benefit that we were examining when we did that. We've modelled 4 cases, so national business as usual, enhanced national stretch, and zonal, various sensitivities on the zonal as well. In the national cases, we've modelled a national wholesale market and a balancing mechanism to resolve transmission and inertia constraints. In the zonal cases, it was a zonal wholesale market and a balancing mechanism to resolve inertia constraints only. For demand and generation capacity, the scenario is based on the holistic transition pathway from the future energy scenarios 2024. So just in slightly more detail on that, for some types of capacity such as nuclear, the model capacity tracks taken directly from the scenario all the way to 2050. For offshore wind, we did amend that to achieve 50 gigawatts by 2033, which was considered more realistic than 54 gigawatts by 2030. And for all other technologies, generation capacity to 2030 is taken exogenously from the scenario, with further economic builder capacity from 2030 onwards being assessed and built endogenously by the model, which is our proprietary BID3 model. And then on network expansion, so that's based on exogenous assumptions from the Energy 10-Year Statement 2023, and also the more recent NESO's Beyond 2030 plan until 2030. And then from 2035, we've got the endogenous network expansion based on the capacity expansion module in BID3. And then interconnector build is based on announced projects in 2035, and then additional endogenous build from 2035 onwards. In terms of the locational investment patterns for generation capacity and transmission network expansion, those were optimized only within the national BAU case. And then we held that pattern of network and generation build by location and mix fixed in all the other cases. So that means we've not assessed the impact of zonal pricing on generation locations. But as we're only interested in looking at the operational efficiency, that's actually in line with the aim of the project. And finally, the model scenario did achieve net zero emissions by 2035 as we intended it to. Next slide, please. Okay, so obviously with the market design elements, we had to actually translate those into modeled input assumptions, and we've got that summarized here. Yeah, so I won't go through everything, but just to say on the pre-gate closure for interconnectors, yeah, we're effectively, because we only effectively modeled a day ahead and a balancing mechanism, the effects of counter trading essentially reflected within our bid and offer assumptions for interconnectors. And we've calibrated the bid and offer assumptions for the enhanced national and enhanced national stretch, and indeed for the national BAU based on historical data. So that involved, yeah, examining a 12-month period for actual counter trading volumes, identifying the potentials in the enhanced national and the enhanced national stretch based on yeah, the alternative costs and how stretching we thought we could be with some of the assumptions. And then, yeah, what we did was we ran a historical year repeatedly, basically 2024 historical year, to match the either the potential or the historic volumes with the amount that was actually seen historically in order to calibrate the bid and offer assumptions. And as you can see, and as you'd expect, the bid and offer prices are smaller in the enhanced national than in the national BAU, and smaller again in the enhanced national stretch, reflecting the increased flexibility. Yeah, and then we've got other assumptions in there as well, reflecting the other aspects of the market design, which you can see there. Yeah, and just to mention that for the zonal, the assumptions in the balancing mechanism are the same as the national business as usual. But obviously it's, yeah, a bit less critical in the zonal in that we're only resolving inertia constraints in the balancing mechanism in the zonal case. Okay, next slide, please. Okay, so onto the results then. So what this chart shows is the total social economic welfare in our enhanced national and zonal cases relative to the national business as usual baseline. So yeah, just to be clear on what the numbers mean. So we're showing net present values of economic welfare for each market design case, which have been calculated over an appraisal period from 2030 to 2050 inclusive. And we've got a 3.5% discount rate. So we calculate the economic welfare in each of the cases and yeah, subtract the future case from the national business as usual case to show the change in welfare in the new market design relative to business as usual. And what we see from that is that the enhanced national case achieves a 0.8 billion total welfare benefit, and the enhanced national stretch gets to 1 billion. If we compare that with the zonal case, 3.3 billion, yeah, that's got some cost of capital increases in it for non-CFD supported capacity, and that gives a benefit of 3.3. But we've also got the zonal cost of capital sensitivity, where an additional increase in the cost of capital for CFD supported plants is applied. So that's 100 basis points increase in hurdle rates for new CFD supported capacity. And the effect of that change is that we get a net welfare disbenefit, and the overall, it's an overall cost worse than business as usual of 7.1 billion. So this highlights the fact that if a zonal market is introduced, it is essential that it is accompanied by extensive risk management frameworks in the form of comprehensive transmission rights, and there is suitable grandfathering as well. So overall then, an enhanced national market design could be delivered with more certainty of achieving at least some positive operational efficiency benefits than a zonal market, which does potentially have higher benefits, but much larger downside risks as well. If we go on to the next slide, Edwin. So another conclusion is that the potential welfare gains from small-scale storage assets are smaller, but potentially more easily achieved than those for interconnectors, which are obviously more dependent on negotiation with interconnected TSOs and potentially the EU. So we ran two sensitivities on the enhanced national case, which has the total welfare benefit of 0.8 billion that you see on the left, the same as the previous chart. One sensitivity was applied based on applying only the changes for interconnectors, which gives a benefit of 0.7 billion. And the other sensitivity was based on applying only the changes for small-scale storage assets, and that gives a benefit of 0.5 billion. And you will see that the sum of those separate benefits is greater than the total of 0.8, which is achieved when they're combined. And this is because the benefits of interconnection are greater if small-scale and storage assets are utilised less effectively, and vice versa. So they're not additive. But to some extent, this makes the enhanced national design, which is based on many smaller interventions, more robust. So failure in one area doesn't necessarily mean that all or even most of the total welfare benefits would necessarily be lost. Next slide, please, Edwin. Okay, and then just looking again at the zonal case, and the chart on the left. So in terms of the zonal market, the benefits of 3.3 billion that we showed previously are compared there with the total consumer bills over the same period. And what you can see is that the total benefit is small relative to consumer bills, less than 1%. So certainly small compared to perhaps the size of the reform that would be required to achieve a zonal market. If we look at the chart on the right, we can see that there are various risks which could reduce the benefit of the 3.3 billion further. So the one on the far right is the cost capital sensitivity, which we've already discussed. And as you can see, it's the single most important risk. Another risk with the zonal market, given the size and complexity of the reform, is delayed implementation. So we did a sensitivity on that, delaying implementation of a zonal market from 2030 to 2032, and assuming business as usual carried on until 2032 in that case. And the effect of that was that 0.8 billion of welfare benefit was lost, so only a benefit of 2.5 billion if that were to occur, quite significant given it's only a 2-year delay. And then the EU compensation sensitivity relates to the fact that in the zonal case, part of the welfare benefit to GB is actually a wealth transfer from other markets rather than a system cost reduction. And part of that is profits being made by foreign generators as a result of less interconnected redispatch in the balancing mechanism, which is retained in GB in the zonal case. So that amounts to 0.8 billion. And what that means is that there's an economic disbenefit to interconnected markets if GB introduces a zonal market, which is possibly something that interconnected markets may be unhappy about. So we perceive that there is at least a possibility that this issue could become politicized and become a topic of discussion under the Trade and Cooperation Agreement, which is due for negotiation in 2026. If that happened and resulted in a wealth transfer as a result of compensation being negotiated on it, that would reduce potentially the benefit to GB. And then, just also to note that that isn't an issue in the enhanced national cases, because although the costs of interconnected redispatch actions are lower than in the business as usual, the overall volume is higher, and the overall effect is that there's actually a small increase in redispatch profits for foreign generators in the enhanced national cases. So they actually do slightly better, and there's a welfare transfer out of GB as a result of that. So in that sense, interconnected markets might prefer Britain to go with an enhanced national design, and potentially that could be a bargaining chip if the issues of NTC restrictions for counter trading came up in the negotiation as part of the TCA as well. As an overall conclusion then on zonal, the potential welfare benefit is relatively small, but it also has additional risks compared to an enhanced national market design.
So Tom, thank you for talking us through that in some depth. So I'd like to bring us back to the next level up. So the key messages for the study, I think I'll talk about the bit on the right first, actually. If we go to an enhanced national market that we believe is quite achievable, you can get operational efficiency gains over this time window from 2030 to 2050 of about 0.8 billion. If you go to what we're calling the enhanced stretch, and that's things that are harder to negotiate, but we believe still credible, but harder to achieve. With the interconnector counterparties, you could get up to about 1 billion. Conversely, we've modeled a zonal market. And this is pretty consistent with the benefits that we found from a zonal market last summer, where we found about 4.1 billion, I think, from memory on a zonal market. It's also quite consistent with FTI's modelling a little while ago of a zonal market, where they found about 50% more benefit than us. I think they found 6.2 billion over this period for a comparable scenario. So we found roughly 1% of consumer bills over that period could be achieved from moving to a zonal market design. And I think at that time, FTI found about 1.5%. Those previous numbers, the 4.1 billion, included efficiency benefits, but we concluded at that time as now that you could really get those, investment efficiency benefits, but we concluded at that time as now that those investment efficiency benefits could be achieved even under a national market. So they're not in the comparison. So if you have no impact on the cost of capital, you could gain, between 3 and 4 billion on a zonal market. But if you allow that there's some small and credible negative impact on the cost of capital, that 3 to 4 billion benefit could easily be outweighed quite significantly by the cost of capital. And we haven't included any implementation costs. Originally, we were thinking the implementation costs would be noise compared to the scale of the benefits. I don't think they would be. But clearly, the implementation costs for a zonal market would be rather substantially more than a national market. So we're seeing that with the zonal market, you could get credible but not huge operational efficiency benefits that could quite easily be wiped out by the impact of risk. Whereas on the enhanced national, you could get a smaller but a much less risky set of benefits. So that's the gist of the findings. So let me go through the key messages, the way we phrase them. An enhanced national market design could be delivered with more certainty of achieving benefits than a zonal market and with less risk of delay. The zonal alternatives has a wider range of outcomes from plus nearly 4 to -7, with higher potential benefits, but a higher potential for significant downside risk. So if we move back to our enhanced national, which has been the focus for this study, a lot of that comes down to improvements in interconnector arrangements, because in the end, if you look at the practical reality of a redispatch market, you end up dispatching substantially the same as you would in a zonal market. The difference is the process you use to get there. People kind of plan around a day ahead unconstrained market, and then we have to change their plans and compensate them for it. But if you look at the fuel and carbon burn, there isn't actually much difference between the two, except for interconnectors, where the Norway interconnector gets locked day ahead, and we don't have very good arrangements to include the other interconnectors in redispatch. So there is a genuine reason why interconnectors are different in the comparison of a zonal market or a national market with redispatch. But any changes to interconnector arrangements cannot be achieved unilaterally. They would require negotiation with the neighbouring TSOs and potentially the EU as well. Now, we think this is true either for the national enhanced or for the zonal design. The Trade and Cooperation Agreement, one of the annexes, explicitly refers to the zonal markets of the EU, or words like that, and the UK market. It doesn't explicitly reference zonal pricing within Britain. It's a matter of legal interpretation whether we have the right to do that unilaterally within the terms of the TCA or not. But I don't think you'd be able to do it without having a compensation at the very least. And there may be some claims for compensation, who knows? So I think that's true on either side, whether we go for an enhanced national or a zonal. And by the way, they're not necessarily alternatives, but I'll come to that. So what we've said is, in addition to the interconnector arrangements, there are potential welfare gains from improved arrangements for small scale and storage assets. They're smaller in magnitude, but more easily achieved than those for interconnectors. And we've set out a few ideas what those might be. And they are indeed some of the things that DESNZ is considering now that were written about in the December update. So other areas of reform could provide further operational efficiency gains, but have not been quantified, and specifically the reformed access rights for storage assets and local constraint markets. And again, those were mentioned in DESNZ's December update last year. So this is a study of modelling where you model perfect foresight, etc. We think the zonal benefits are likely to be lower than modelled, and possibly significantly outweighed by either the increased cost of capital for new renewables, delays to implementation, and also imperfect market coupling arrangements even within the zonal market, which is kind of combined with imperfect foresight. So, the implicit assumption is that the zonal market has perfect foresight, and you get a huge amount of benefit if you model a perfect foresight zonal market. If you model an imperfect foresight zonal market, even compared to an enhanced national market, I think you would find less benefit. But it's very difficult to model the impact of uncertainty. But certainly the higher trading and hedging costs, which is the final point, I just mentioned compensation arrangements to the EU if we were to move zonal. So our conclusion remains as it was 9 months ago, that the range of outcomes associated with a zonal market is greater than that of an enhanced national market. If you get the hedging and risk management right, you can ensure you stay above the line. Sadly, in the work I've seen of the consultants working with DESNZ on the zonal market, I see no evidence that we will be moving towards a market where this is the first rezoning of many. So whatever grandfathering arrangements we use today will continue to be used for the future, that we don't purely limit ourselves to things like financial rights or concepts of revenue adequacy for the TSO, but we actually look at the type of trading and risk management instruments that are needed for today's and for future trading, including PPAs between data centers and renewable generators in different parts of the country. So if a program of work was being delivered to deliver a comprehensive and well thought out set of transmission rights to hedge risks, we could maybe stay above the line on the yellow, but I don't see much evidence of it so far. If we were to move to a zonal market, it will take a number of years, especially if we were to do it properly, as a result of which it would certainly be worth looking at the recommendations we've made on the enhanced national, because they'd be there for a few years before the zonal market goes ahead. So I don't even see these as clearly alternatives to one another. But our conclusions remain that this is, in political terms, an interesting decision for the minister, for those of you that get the reference, and Tom I know is too young. The overall benefits seem small compared to the scale of risk that a zonal market would implement. And we think there are probably lower risk issues to be looking at. So Tom, have you got any concluding remarks? No, this is probably then for me to for me to go through. So our recommendations are for delivering an enhanced national market design with low regret. It could yield benefits ahead of, and that doesn't necessarily imply instead of, it could be ahead of any zonal market implementation. So progress to the maximum extent possible the enhanced national stretch market design elements, and that still gives some fallback options. In the end, it's about negotiation with other TSOs and markets and finding out where there are areas of mutual benefit, and that's the critical point here, and we're sure that there are some. We suggest undertaking a rapid development of measures to improve operational efficiency for the small scale and storage assets within the existing national market, and these are the ones that aren't traditionally in the balancing mechanism. We should recognise that improvements to interconnector arrangements are needed, whether for the zonal or the enhanced national market design, and these should be pursued bilaterally and when necessary at EU level, if that reset is serious. And I know there's limited appetite at the European side for sector-specific cherry picking, so I don't think we'll be rejoining the internal market for energy anytime soon, but there is certainly plenty of scope for improving those arrangements. And we also must recognise the impact of network build on the benefits of a zonal market design. And we should be continuing to accelerate the coordinated grid build as it's being planned. And that does include making full use of NESO's powers for delivering the spatial energy plan. So again, Tom, do you have anything to add at that concluding point?
Nothing from me.
Thank you. So I'm conscious we haven't left a lot of time for questions. Having said that, I don't see many questions in the chat. There is one question on how we've treated demand side response. I mean, I will say that demand side response is one of the arguments in favour of a zonal market. Under any other market, demand response is, that's too expensive, I don't want some. In our markets, in energy, we tend to think demand response is somebody selling a service as opposed to not buying one. And with a zonal price, you can, if you're exposed to the zonal market, you can avoid buying at places and times when it's expensive, and you can buy more when it's cheap. In a national market, you have to effectively offer yourself up as a balancing service or in a local market design. So we have modeled demand response on both sides of the equation, but intuitively, that is one of the factors in favour of a zonal market. But we have assumed that some of the demand response would be accessible in redispatch arrangements. And Tom, feel free to clarify that with the detail of anything on the modelling side that I've left out.
Yeah, so I think we recognise that certainly flexible demand, is one of the drivers of some of the benefits in the zonal case, and the ability of a balancing mechanism to optimise that as well is probably inherently limited by the fact that it requires explicit capacity products and auctions and so on to make the best use of it. So it's probably inherently an area where you can't hope to replicate 100% of all the benefit of a zonal market. So our modelling assumptions somewhat reflect that, in that we are less flexible in the way that we model flexible demand in the BM.
Right, well, I think our hour is up. I believe I can only see one question in the Q&A, but I believe there were one or two more that were submitted in advance, which I can't immediately see. So we'll take a look through those and perhaps follow up with written answers to some of the questions if we think they're illuminating generally. Otherwise, thank you all for your time and for your attention. Don't hesitate to follow up if you've got any clarifications you'd like.